Hello, and welcome back to the Argyle CFO Leadership Forum. My name is Brittany Sullivan with Argyle, and it's great to have everyone joining us today. I have some important information to share with you, and then we will turn the floor over to our esteemed keynote speaker. First, a quick reminder to stop by our sponsors' virtual booths at any time during today's event and for the following week. Our partners are committed to providing you with valuable content and a great overall experience. At any time during today's event, you can visit their virtual booths from the main agenda page, which includes complimentary materials, information, and meet and greet opportunities. To ask questions throughout the session, simply type into the Q&A chat and we will address your questions at the end of the session. Now, without further ado, I would like to introduce our speaker, Simone Grimes, Chief Financial Officer at Acadia Insurance. We are excited to have Simone with us for a keynote presentation titled CFOs and ESG, Promoting Sustainability to Increase Company Value. Welcome, Simone, and over to you.
Thank you so much. And as Brittany mentioned, my name is Simone Grimes. I'm the CFO of Acadia Insurance, which is a W.R. Berkley company, and it trades under the New York Stock Exchange as WRB. Before we go any further, I do want to say that the views and information that I present today are my own and do not represent the views of W.R. Berkley or any of its affiliates. They should in no way be misinterpreted as commitments or plans. Rather, this is information and educational in nature and is meant to discuss ESG in a broad and general way. So now that we've gotten that out of the way, I would love to hear from you through the chat what roles you represent and what industries you represent. And there's a bit of a delay from the time I ask you the question till I start to see it. So in the meantime, I'll kind of go on and discuss a little bit about what we're talking about. So again, if you can add in the chat your title, company, role, and which industry you operate in, that would be great. Next slide, Brittany. Can you go advance to the next slide? Oh, one more back, or two more back? Okay. So today we're really going to primarily focus on a few key topics regarding ESG. You will note that ESG is a very broad topic, and the notion that ESG relates to company value is essentially going to come from many perspectives, but namely a perspective of the investor and from employees. So our topic today is really focused on sustainable initiatives to help promote employee wellness and environmental preservation, and developing a compelling story to show investors how your organization is increasing value or implementing ESG efforts. So I can see from the chat that we have some people from the communications industry, cybersecurity, pharma, streaming, and tech and manufacturing. Excellent. I think you'll see that as we go through this presentation, the content can be very industry specific, and the manner in which you implement or consider ESG is going to be very tailored to the industry in which you operate. So it'll be important to note that this is just broad general information, and then of course there's much more granular and specific guidance that is relevant at an industry level. So, and then we also have some people in nonprofit and logistics. That's exciting. I love having people from the nonprofit sector. We're going to talk a little bit about that, and retail and manufacturing. So when I think about company value, it's a very interesting topic, and you know, on any given day you can hear you can see a flurry of information about whether ESG is or is not actually increasing value, and value can be measured in a number of ways. Most often for publicly traded companies in terms of the share price that day, going back a quarter, and if your analyst is looking at a longer term proposition, then maybe even going back a year or 5 years, although that is unusual. So I think it's important for us to take a step back and actually consider what ESG means in terms of value and what it does not mean. So I actually wanted to do just a bit of a dive back onto ESG and its background. What I often hear is that it seems as though the concept of ESG just kind of emerged and it's coming out of, it came out of nowhere and it's coming from every direction. And the reality is that's exactly how it was intended. There was a very strategic push to bring this concept to the forefront of key market players' attention, and that push has been successful. So next slide. So as early as 2004, there was a organization or a group of financial institutions that was really called to action by the United Nations to come together and to consider whether or not environmental issues, social issues, and governance issues really had the ability to shape markets. And what came out of that was a paper that's titled "Who Cares Wins: Connecting Financial Markets to a Changing World." And I would really recommend that everyone go and look up that paper because it really is astounding the extent to which, over the course of almost 20 years, the philosophies and ideals proposed in that paper have actually come to bear fruit. So essentially at that time, you had 20 financial institutions as well as members chartered through the UN who came together and really sought to understand how could financial markets endorse a philosophy, an investment philosophy that would ensure that the globe, the environment, the climate, et cetera, actually won at the same time that businesses were succeeding. So the subsequent year in 2005, there was a further conference. So that first one had about 20 investors. The second one had about 63 members from the asset management side, the buy side, and the sell side, as well as global consultants and government bodies and regulators to examine the role of environment, social, and governance issues as it relates to a financial investment approach. And there was essentially a remarkable agreement. And what came out of that was several questions about the legalities of imposing an ESG, environmental, social, and governance component on an investment strategy. And the corresponding white paper that was written was called the Freshfield Report. And that Freshfield Report was essentially to introduce or clarify the legal framework for the integration of environmental, social, and governance issues into investment policy. And so when we say investment policy, we are being explicitly including asset allocation, portfolio construction, stock picking, or bond picking. And to really answer the question of whether it was or was not legally required or permitted, and whether it would be hampered by any existing law or regulation. So as we go through this presentation, you'll see the engagement of lawmakers and regulators, which was essentially deemed as important to further this broader view of imposing an ESG element into the way that we invest and the way that we value companies. Out of that, there came some principles. So there was the Principles of Responsible Investment that was published and considered in the United States, as well as the New York Stock Exchange, which launched the Sustainable Stock Exchange Initiative the following year. And then, it wasn't planned, but it certainly didn't hurt. We had the financial recession of 2007 and 2008, and it really stemmed a lot of awareness among all key stakeholders that business had the ability to really deteriorate society. So we saw local economies collapse. We saw people being foisted out of their homes. We saw that poor business decisions could disrupt society in an untenable way. And that really resulted in a lot of activism, really wanting to rein in Wall Street and rein in capital markets and ensure that society was considered as a part of this broader view of how companies operate. And some of the corresponding regulations that we saw was the 2010 Dodd-Frank Act, which was a Wall Street Reform Act. And if you could remember, for those of you who do remember, and I might be dating myself, but there were activists, really pitching tents right outside of Wall Street and really demanding reform and suggesting that it was not fair that companies could make huge returns, have minimal punishments, and yet disrupt society as a whole. So when we saw the 2010 Dodd-Frank Act, in response, I think there was a great awareness by companies that if left unchecked, we will be regulated into submission. So we should, in fact, come up with our own philosophy of how we consider the broader society in terms of how we produce profits. Next slide. And so a very key action that took place in 2019, and this was, I can't overstate how pivotal this was. This was essentially a statement that came up by the Business Roundtable, which is comprised of approximately 180 CEOs of some of the larger companies who came up with their own public statement. And this was to essentially divorce themselves of the previously held Friedman doctrine. And for those of us who went to business school, you know that Milton Friedman has been well regarded for decades as one of the leading proponents of capital markets. And his philosophy was always that the primary purpose of a corporation was to serve shareholders and maximize profits. This was considered a shareholder maximization philosophy, that is really the only goal of a company, is to enrich its shareholders. And then that philosophy had been in existence and continued to be in existence from 1976 all the way into 2019. The Business Roundtable made a statement. They had been meeting regularly and essentially put out guidance that reinforced this statement, or this basic philosophy by Milton Friedman. But in 2019, they reassessed who their stakeholders were and expanded it to not only be shareholders, but to also include stakeholders, but to define it as stakeholders who were defined as customers, employees, suppliers, communities, and shareholders. Now, this is a big change from what was always previously considered to be the purpose of a corporation. Under the Friedman philosophy, to the extent that shareholders wanted to invest in society, they would do that from their profits or their earnings, or they would demand that the company do so. And we'll see a little later on that has actually bear true, and that shareholders are demanding that companies do so. But under the Friedman philosophy, this is essentially not the main purpose of a corporation. Under the Business Roundtable philosophy, which came out in 2019, they went a few steps further and actually defined what it would mean to honor customers, employees, suppliers, and communities. So for customers, they stated that they would further the tradition of American companies leading the way in meeting or exceeding customer expectations, but they also took ownership for the product or the end value that the customer received as a result of engaging in a transaction with the business. In terms of employees, they actually affirmatively stated that they would compensate employees fairly, provide them with important benefits, as well as supporting training and education to help develop new skills for a rapidly changing world. So this was a really big acknowledgement that the world is changing, and that as we adopt these ESG initiatives, that we have to evolve our workforce to come along with us. They also mentioned fostering diversity and inclusion, dignity and respect. The other thing was dealing ethically and fairly with suppliers. And we'll see this as we go through the ESG framework, that suppliers and how we get the key components that produce, whether it's our products or our services, becomes a key measurement for the ESG framework. And so in 2019, the Business Roundtable suggested that they are dedicated to serving their good partners and other companies, large and small, to help them meet our mission as well as their mission. And lastly, to support communities in which we work and to respect the people in our communities and protect the environment by embracing sustainable practices across the business. All these in whole essentially allude to the notion that rather than ensuring that shareholders received a quick and short-term value, they would instead receive long-term value for shareholders. So this is essentially dialing away from the quarter-by-quarter quick returns and suggesting that the capital afforded to companies would assist in ensuring that the world, the environment, the employers, suppliers, et cetera, are served in the long run, and that shareholders would be enriched by this process. So next slide. The reason that I mentioned that you should go back and look at that Who Cares Wins is because it really lays out this framework that was really well defined and really well articulated. And we're going to go through some of the key players and their roles, and we are going to talk about how successful they have been. So whenever I hear a comment that says, I'm hearing from ESG from everywhere, it's important to know who you're hearing it from and what is the message, because each market player was given a key role. And what we just talked about was companies and the pressure they received to embrace a more holistic view of how they approached business transactions, but we also need to look at some of the other key players. So next slide. So as early as 2004, and I'm glad that I got to learn a little bit about where some of the people in the audience are from. I saw a question that says, will there be some resources available at the end of this presentation? And yes, I will share some resources, and I'm happy for those to be shared with all of you so that you can look them up a little bit more. So what I found truly fascinating is that as early as 2004, in that famed publication, Who Cares Wins, the framework of all the critical players and who they would be and what they would do was very well articulated. So based on the responses to the question about where you're from, most of us sit in the upper left-hand quadrant, either accountants, work with standardization, or work within a company. And then you'll see that on the right upper hand quadrant, there's a heavy focus on analysts, investors, asset managers, and pension funds. And I think it's very key to understand when we talk about value of a company, who is actually valuing a company, and really honing in on where do the larger percent of assets or the ownership of companies sit. And we do know that those sit mostly with our large asset managers. And so it was very important when we look at this, if we think about this moving like a clock and you think about who's most important in this new theory, it was very clear that analysts, brokers, investors, asset managers, pension funds, et cetera, those who own the assets would be key in actually creating change. So as we go through this presentation, we're going to talk about almost every component on here. We're not going to spend that much time talking about pension funds and NGOs, so I'll just quickly kind of mention them. So pension funds were essentially mentioned or included in this framework because they were encouraged to consider environmental, social, and governance issues. And in the past 2 weeks, we've seen a lot of pushback. So when you think of pension funds, you're thinking about, large labor unions, you're thinking of state employees, large pension funds that incorporate a huge amount of stakeholders. When these pension funds shift their interests, it has the ability to move markets. And so what we've seen is a lot of political pushback about actually permitting pension funds to make decisions based on ESG criteria. So I would invite all of you just to, I don't profess an opinion on that, but just Google it and you can see the kind of combating views on that perspective. But I think what's critical for the purpose of this conversation is to understand that that is a key stakeholder and it has the ability to really inform the decisions made by companies by how they're making their investment choices. The other is going to be NGOs, and I believe there is at least 3 people in this conversation who represent NGOs. In the context of this framework, NGOs are largely contemplated as being, number one, providing research, but also being an arm for which companies could reallocate cash and capital to actually facilitate its broader ESG issues. So I think a really good example is Tom's. Tom was that shoe company where they had a buy one, give one. So essentially every time you bought one of their products, they would in turn ensure that someone who needed shoes would get a pair of shoes. The notion of having the company itself, and I know that's a failed story. Tom's was close to declaring bankruptcy in 2019, and they've had to divert from that strategy. But just as an example, this is one where you're using the business acumen and the talent of a company to actually engage in a something that is more suited to a nonprofit or an NGO, where that is truly their mission. So it was important to have all of those community members present to help facilitate this and support the financial community. Next slide. So I do see a question about whether or not non-public companies are required to do ESG disclosures. I'm going to go over the public company disclosures that are required, and just know that the extent to which a non-public company is required to do this disclosure is going to be more largely dictated by where it's getting its funds from, where its source of capital is, and we are going to talk about the kind of big three capital investors and what they are requiring and demanding of their underlying portfolio companies. Oh, I have 10 minutes remaining. Okay, let's go quickly. So investors and asset managers were asked to reward ESG factors in their research, develop and communicate proxy voting strategies, which they have done. Large institutional investors like pension funds and others were also asked to consider ESG factors in the selection of their asset managers, consultants, and assets. They were all asked to proactively consider ESG in their asset selection. Next slide. There's often a question about whether ESG is going away, so I think it's important just to see how quickly it has ballooned. And that's to say that back in 2006, there was about 6.5 trillion assets under management that were represented, and there was dedication to diverting those assets to ESG assets. And the most recent survey suggests that by 2025, a third of the world's global assets under management, over 50 trillion, will be diverted to ESG assets. So I think the answer to that question is it's not going away. Next slide. So we're going to talk a little bit about consultants and financial advisors and analysts, because this is where we're hearing a lot of the information, and that eventually funnels into some of the regulatory requirements that we're seeing. Next slide. Okay, so as I mentioned, the Business Roundtable essentially well, companies as a whole, they were asked to take a leadership role in implementing ESG. We did not see that happen. So this is back in 2004. We didn't see many gains in that space. And the reason is because shareholder capitalism versus stakeholder capitalism, at the end of the day, each company is rewarded quarter by quarter, day by day, in terms of how is their stock performing. So the true question that was being asked of them was to sacrifice short-term trade-offs for long-term trade-offs. And most CFOs and most companies would agree that that sounds ideal in nature, but it does not work necessarily unless all people are bought into that premise. And so when we talk about company value, this is going to be important to realize that there is not a direct benefit to the bottom line that a company expects to see by investing in ESG. Nor, I think the best example would be to suggest that when SOX was rolled out, was there a direct and corollary increase to the bottom line? Over the long term, yes, the extent to which there's management controls, you don't see as much fraud, et cetera. But in the short term, it was more so an expense. So let's go to the next slide, which really codifies who are the players that are actually driving the change that's being required. So ISS and Glass Lewis, most of you, I'm sure, know that. They are the two most prominent proxy advisory services, and they really focus on voting on who stays on the board, say on pay, as well as other strategies that the company has. And then BlackRock, Vanguard, State Street. They are your large asset managers, and they own more than 20% of the shares of the average publicly traded S&P 500 company. They're also big players in the private equity. So for the question about whether or not a non-public company requires an ESG strategy, to the extent that Vanguard, BlackRock, and State Street are among your capital investors, then yes, they are going to demand that. I would say also suggest that where the large players are making their moves, so do the smaller players. So we're seeing this throughout the value chain. Next slide. So how are BlackRock and State Street, as well as Vanguard, actually making change? They're voting. They're using the proxy voting process to vote. So in 2021, they voted against 255 directors. So the board of directors represents the companies. And in turn, they're voting those directors who are not supporting an ESG strategy off the board. That is how this is the most compelling way in which this is actually being brought to bear. Another great example is that State Street, similarly, they voted against directors in 313 companies. because the boards lack diversity. And we're going to talk a little bit about what these two players want to see in their underlying companies and those that they invest in. BlackRock, Vanguard, and State Street, there's not a specific call out for Vanguard because they've been a little bit more vague in what they are requiring, but collectively they are considered the big three asset managers, and they do control over $21 trillion in assets, which would be equivalent to the entire US economy in 2017. They essentially joined forces and voted against the board members at ExxonMobil for not furthering ESG priorities. So we can see that the proxy vote is one of the main ways that companies are exerting their premise and demanding change from their companies. Next slide. And I think we're actually going to have to skip down. So I have some information here about what ISS is demanding and Glass Lewis is demanding. And let's skip down a few slides. There's also a great case here, and I believe the slides will be shared afterwards, which shares a little bit about how some of our activist shareholders have been able to influence change and to galvanize the forces between the big three asset managers and the big two proxy advisory services, and to actually demand change from companies. And then let's flip down a little bit. Next slide. So I do want to hit on some of the SEC regulatory requirements in the United States. So there were some questions asked about whether or not this is required. And so as of right now, when we think about the SEC has been moving a few steps behind our large investor groups and our proxy advisors. They have hinted at some change. They released an interpretive guidance back in 2010. They issued a concept release in 2016, and then 2021 and 2022 is when we really saw the big rules come out, which are still proposals but are intended to stop companies from greenwashing. So when we looked at that chart, which showed all of the hedge funds that now are dubbing themselves as ESG funds, many of those are doing so under the auspices of not truly being sustainable. And so we're seeing a big check by the SEC to kind of denote and denounce some of that information. We also know that in 2022, the UK enacted 2 mandatory ESG disclosures, and the US is typically a year or 2 behind the UK when it comes to these mandates. I want to get to, I think we only have a few minutes left, so I want to get to slide 23. One more up. Sorry, the other way. There we go. Okay, so when we think about what is required and what it takes for a company to actually implement an ESG strategy, there are 3 core pillars. There's the environmental pillar, the social pillar, and the governance pillar. Essentially, I would say that the most important one, and the reason it's the most important is simply because it's the most easy to measure, is the carbon emissions component under the environmental pillar. This is the one in which we're seeing the SEC and other regulators demanding much more granularity in terms of indicating how much emissions are being spent in your direct operations as well as through your upstream and downstream channels. The social pillar, what we're seeing more is kind of an emphasis on human rights laws and diversity and inclusion. And then governance, what we saw from the large asset managers and the proxy voters is an emphasis on board composition, how they're voting, and the compensation for the boards. So this is an area where you could say that the E and the G are really taking front and center stage, but the G is also focused on ensuring that diversity, equity, and inclusion is a component. And when we come to the rating agencies for ESG, they really are looking at the extent to which labor laws and fair labor practices are in place. And I think we have just 2 minutes remaining, so I would love to just get to slide 29. I do think it's important. Right there, I'm sorry, go back. One more slide. So when we think about how ESG is viewed by the employees at our company, one slide down, it's important to note that employees are just a composition of the United States, and the United States is divided among these issues. And so how do we actually galvanize the workforce to agree on these issues when we as a country or we as a society don't necessarily agree? Next slide. There's three key areas that McKinsey affirmed in a recent study that I think bear true, and that's how to make this part of a differentiator for talent. And number one is to make ESG a key part of your company story, and that's by really leveraging your communications channels to continuously re-emphasize how important this is to your company. Number two is most people do not like when we talk about regulatory changes or, in this case, investor-led changes, because they believe they're going to be left out. So it's really important to do what the Business Roundtable said, and that is to create roles and to train and upskill your staff so that they can participate in the new roles that are required under the ESG pillars. And then the last is to enable inclusive transition for all workers, regardless of personal views, regardless of skills that are currently present at the time. It's important to engage them and tailor communication so that we can all understand why we as a company are moving forward. I don't think I have much more time. I wanted to go to the very last slide. Yes, stay in touch. I do see your questions. I think I've answered most of them. There was a question about which component of ESG is the most prevalent, and I would say it is the emissions. There's going to be the Scope 1, Scope 2, Scope 3 emissions. We didn't get to go into detail in that. That being said, if the presentation is shared after this, I do provide some examples of that. And stay in touch. I try to share information, connect with me on LinkedIn, and it's been a pleasure to be with you today.
Excellent. Thank you so much, Simone, for such an insightful presentation. And any questions that we did not get to, I'll be sure to follow up with you or share those with you afterwards. And thank you everyone who joined us for this fantastic keynote. This session, along with all of today's content, will be made available on demand following the event. Thank you again.